Fed funds rate itself is not the direct indicator directly correlates. There's a kind of a lag period between as the Fed funds rate drops before it translates into the mortgage rate, because there's some basic principles in terms of what's the Fed funds rate, then what's the spread between a Fed funds rate and the 10-year Treasury bond yield, and then there's a kind of a standard spread or yield differential between the 10-year bond yield and a conforming 30-year mortgage. So indirectly, as the Fed funds rate drops, that typical spread between that and the 10-year bond yield, about 1% or so, is going to follow. So the 10-year bond yield will trickle down as well. And then that spread between the 10-year bond yield and a typical conforming mortgage rate, which generally can run around 1.5, 1.75%, that's going to cause the mortgage rate to fall too. So they're all interconnected. The point I keep trying to tell people is it's not immediate. The Fed funds rate goes down a quarter or a half. You're not going to see that mortgage rate drop immediately by that same amount. It takes time. Mm-hmm. I think this current downward trend that you're referring to, where it's circled on the right, I think it's going to continue, but it's not going to be quite as sharp. It's not going to be a fall off the cliff type of a drop like you see in 2000 or 2008. I think it's going to be a little bit more gradual, which I think ultimately is healthier and probably better. But that underscores the fact that if you buy a home now, and you negotiate that concession, that price reduction, but in a more imaginative way of get that concession, buy down your rate for 2 or 3 years, I think that downward trend, that gradual trend, is going to set you up nicely as you approach the end of your buy down period to be able to refinance that note rate into a lower rate long term. And I think that's going to be a very good play for those who've got the imagination to go out and try to make it work. And we can help you with that.